US Treasury yields drop sharply on more confidence the Fed can cut 3 times this year. The Bank of England cuts its rates, but only just. China's factory output contracts in July, and Australian exports to China fell. All eyes are now on US non-farm payrolls tonight. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, we return to our coverage of China's weakening consumer confidence, with ANZ agriculture economist Susan Kilsby talking about how authorities there are trying to revive demand.
One thing they have been doing is pushing down interest rates with the hope that that'll increase spending back and confidence back in the property sector. Thus far, we're not really seeing any change.
But first, in 5 and 5 with ANZ, US Treasury yields sank 5 to 8 basis points to their lowest levels since February overnight after more weak US economic data. The 10-year yield fell 5 basis points to 3.98%. We haven't seen it below 4% since February. US stocks also fell 1.5% to 2.5% as some investors switched to bonds from stocks. The ISM manufacturing survey found factory output in the world's largest economy contracted in July by the most in 8 months and has been contracting for most of the year. Here's ANZ economist Bansi Madhavani speaking from London this morning on how the ISM data affected views on what the Fed does this year.
This week, activity showed that the US economy is slowing down, and that added to Fed's rate cut bets. Some of this is also a continuation to the reaction from the FOMC's press conference the day before. And in his press conference, Chair Powell did suggest that the Fed is open to considering rate cuts beginning September, depending on how the data evolves. So the markets are now pricing 3 rate cuts in the year beginning September.
Also overnight, the Bank of England cut its cash rate by 25 basis points to 5.0%, but only just after a 5-4 vote. The pound and gilt yields fell sharply. US dollar index, though, was up 0.3% by 4 a.m. Sydney-Melbourne time. That saw the Australian dollar down 0.5% to 65.02 US cents, and the Kiwi was flat at 59.52 US cents. Number 2, Australia's trade balance increased by more than $500 million in June to $5.6 billion, as exports led by rural goods rose by more than imports. Export prices dropped nearly 6%, led by commodities and in particular softening Chinese demand for steel. ANZ economist Maddie Dunk says that was made up for by demand from elsewhere.
If you look by country, we often focus on China, and we did see that exports to China fell in the month, down 700 million, but they actually fell more to South Korea, so down 900 million there. And then on the flip side, the country where we saw the largest export growth was Japan, which saw exports to Japan pick up 1.3 billion. So the export story to Japan's been a bit choppy recently. We had seen a dip, and we are starting to see a bit of a recovery there.
Number 3, China's manufacturing activity contracted for the first time in 9 months in July, according to the Caixin's S&P PMI. ANZ senior China strategist Zhao Pengxing says the key driver for the fall was weaker domestic demand, but also that China's export momentum, which has been holding up the economy, looks weaker.
But at the same time, the external demand is also slowing, which can be found from the slowing PMI data in the Eurozone and the US. China factories are facing with insufficient demand both domestically and globally. We saw in Austrade data today that Chinese imports of Australian goods were down.
Number 4, Indonesia's headline annual CPI inflation rate fell in June, coming in at 2.13%. That was below market expectations for 2.44%. ANZ economist Crystal Tan says inflation hasn't been a barrier to monetary policy easing for some time now. Rather, the policy rate will be driven by the currency.
We think Bank Indonesia will wait for the US Fed to pivot before it considers its own move. We also see 16,000 as a potential threshold level for the dollar rupiah that will make Bank Indonesia more confident about cutting rates, but we're not quite there yet.
Number 5, South Korea reports inflation data today. Crystal is expecting the annual inflation rate to hold steady at 2.4% and for core inflation to cool slightly to 2.1%. She says recent electricity price falls are likely to trump the government's decision to reduce the size of fuel tax cuts.
The big picture for South Korea is that inflation is now becoming less of a constraint on monetary policy. And now that we also have the US Fed opening the door to a potential pivot in September, the conditions are coming together for the Bank of Korea to lower its policy rate. Our baseline is still for an October cut.
Crystal Tan there. Now, in our bonus deep dive interview, we look again at China's weakening domestic demand and consumer confidence with ANZ agricultural economist Susan Kilsby, who explains what China's authorities are trying to do to revive demand.
Yeah, so the Chinese economy is changing, and the government has always been able to sort of control the economy to a reasonable degree by giving incentives in different areas to encourage spending in different parts of its economy. So one thing they have been doing is pushing down interest rates with the hope that that'll increase spending back and confidence back in the property sector. Thus far, we're not really seeing any change there. Like traditionally, if they push interest rates down, you'd see a pop-up in demand for property. It's not really happening at the moment, and that really sort of goes back to the underlying issue that there very much is an oversupply of housing within China. You can't really change that in a hurry, so they're not really having the results that they would like to see there. They've also been trying to stimulate spending by giving some subsidies to people to upgrade their cars, particularly to go to new EVs, which also has an impact, reduces their pollution issues. But again, it's not sort of having probably the effect that you would have seen previously, or that desired effect. And that really just goes back to the underlying, issues of the consumers just being a little bit worried about their own financial positions going forward. So they're tending to just sort of hold on to their money at the moment rather than spend. So some of these government initiatives are getting a little bit of traction, but not a whole lot at this stage.
And in the long run, though, is there going to be a demand for the sorts of protein that New Zealand produces in China?
Yeah, I mean, the growth in the demand for proteins in China has been really strong, and it means China have become very reliant on imported foods. They have got a desire at the government level to become less reliant on the global market, and some of that sort of stems back to when, the trade wars were happening with the US 3 or 4 years ago, and they are looking to try and produce more domestically. The real challenge they have with doing that is that they have real limited land area that's suitable for arable and pastoral use, and most of that's dedicated to producing food for people, so there's not a lot of space available to grow crops for animals, and certainly a lot of the forage they need for animals they end up having to import. So it does make it really expensive to farm cattle in China, so whether that be dairy cattle or beef cattle. So at the moment when prices are quite low in that market, their own domestic farms are struggling as well. So that makes it pretty challenging to grow that market, and therefore we really do expect they will continue to be reliant on the imported market, because it can be produced, both milk and meat can be produced cheaper in other markets. So that side of it's not going to change anytime soon. The only area that they probably do have an advantage on in the longer term is into areas like fermented foods, which they don't have the requirement to have the arable land for the input into those areas. So maybe they make some gains there in terms of their food sustainability and being able to produce enough food for their domestic market. But certainly for the foreseeable future, we expect they will remain reliant on imported dairy and meat products.
Susan Kilsby there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, August the 2nd, and our first anniversary from our launch. Thanks so much to all of our contributors. Onwards and upwards for our second year starting today. Catch you next week with the Reserve Bank of Australia's rates decision on Tuesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.